In the world of Indian taxes, there is one number everyone tends to remember: 2,50,000 rupees. If your annual income crosses this basic exemption limit, the law requires you to file an income tax return. However, it is quite common for people with an official income of zero to receive a legal notice asking why they haven't filed. This happens because the tax authorities look for tracks in the snow. They monitor the trail of your financial activities rather than relying solely on a single income figure. Significant spending or moving large sums of money through your accounts creates a record. When these activities reach a certain scale, the system expects a formal explanation of where that capital originated. Under these specific conditions, the annual filing acts as a report that matches your lifestyle and spending to your reported earnings. The first category involves the heavy spender. This identifies situations where cash moves in quantities that suggest a high level of economic activity. Bank activity has clear limits. You must file if you deposit over 1 crore rupees into a current account or 50 lakh into a savings account annually. Similarly, annual electricity consumption exceeding 1 lakh rupees triggers this filing requirement. You might have a legitimate reason for this spending, even with a low personal income. Perhaps you are managing a residential society's funds, or you are operating a small business with very low profit margins. Because this volume of cash movement is so significant, the government requires a tax return to verify that the money is documented and legitimate. The second category identifies the hustle footprints, which apply to freelancers, professionals, and small business owners. For these individuals, the requirements are based on total volume, specifically business turnover exceeding 60 lakh rupees or professional receipts above 10 lakh rupees. It is important to distinguish between total sales and actual profit. A shop might sell 60 lakh rupees worth of inventory, but after paying for staff, rent, and the goods themselves, the owner might only keep a tiny fraction as take-home pay. The tax department monitors the large turnover figure. Even if that final profit sliver is below the taxable limit, the high volume of business activity stays on their radar. Because of this high commercial activity, you file an ITR to demonstrate to the government that your high revenue resulted in a low, non-taxable profit. The final category is the paper trail. These digital tracks are created automatically behind the scenes by government systems or international transactions. The most direct trail involves geography. If you hold any property or financial assets outside of India, you must file a return regardless of your income level. Then there are the taxes collected before you even receive your money, known as tax deducted at source, or TDS, and tax collected at source, or TCS. Filing becomes mandatory if your total tax deducted at source reaches 25,000 rupees, or 50,000 for seniors, or if you have 50,000 rupees in collected taxes. Since the government already holds these funds, their databases have a record of your financial existence. With these digital records already in the system, the authorities expect a tax return to reconcile the numbers and close the loop. Whether through high spending, business volume, or digital records, these activities create a financial footprint that is visible to the system. The income tax return serves as a comprehensive record of this activity for the year. The rule shown at the bottom of this guide is absolute. Meeting any of these conditions makes filing mandatory, even if your taxable income is zero. This tax season, look beyond your basic salary. Evaluate the total financial trail you have left over the last 12 months. Filing your ITR is the formal way to document those tracks and confirm that your financial activity is transparent and compliant with the law.